Hello traders, welcome to the daily market review New York session. This is David, and we're going to be looking at USD JPY for today. So let's get started. So what we're seeing here, we did found the peak formation low, and if you go back, you can see that the price has dropped significantly and created a major support here. However, the price respected this area, creating the peak formation low, W formation, and then started to go into a bullish cycle. So once that cycle starts, you need to track the trend and see how it's playing and how is it been manipulated. So basically what we've seen that the price started to do the impulse, the first wave, and then started to consolidate the sideways. As you can see, if you contain it in a box, it will start to range and it will stay in that range. If you can get that right here, just a peak, just a low, you can see how the price just stays inside and never leaves. And then finally, the breakout happens right about here. Okay, so once the breakout happens, what do you notice? The level 1 was completed, right? And then the level 2 was completed. Level 1 was completed, then the level 2 got completed. So once that happens, you can see once you contain that, you can see the breakout happens right above this high, and that was right about here. Okay, and you can see the price comes back, retested it, but that's basically support, the previous resistance. Now it's a support. For the technical retail traders, they're probably buying here, but we don't do that. We aim for peak formation entries or the level 1 entries right about here, right over here. In this scenario, the level 1 didn't give us the setup that we look for, but the W did give us the setup. So basically, once you find the wave 1, consolidation wave 2, consolidation wave 3, then you end up at the peak formation high. And right over here, what we're seeing here, that the price basically consolidated and it started to do the divergence. So it's basically showing there's a lot of sellers in the market, right? There's a lot of pressure in the market for sellers. So the market maker has to do a stop on high and followed by a drop. So what do we see here? This red line is basically the yesterday's high. So, and that's the support zone. So what we noticed that the price has gone into that zone, and during the Asian session, this was the Asian session right over here. This whole thing was the Asian session. Right now we're in a London, and then followed by the New York. So this New York candle might push it to the high, create a more high, or it might retest this previous high and then continue to drop. But the overall projection of USD JPY is that once the levels are completed, we are aiming for the peak high. So as long the peak high holds and doesn't break above, and this divergence stays active, okay, we can expect the price to shift lower and lower and lower. But until then, we just have to wait it out. Most likely, we're gonna be entering on a short. Here we got an M formation, a small M formation with the Asian session, impulse, 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 M formation drop. So that was a bring straight setup, and then it reversed. And here you can see that was a bring setup also. So one push, that's the multi-session M. So one push down. So this could be a level 1, and this could be the stop hunt. So what we need to see is wait and see if the price comes back again here. If not, this could be drop. Because the price already created the M formation, so we're not expecting any more stop hunts. But however, it's only a 2-day stop hunt, so 1 day and 2 days. So whenever there's a 2-day, there's not a lot of volume being carried in that trade. So when we look for good setups, we look for a 3-day rise, 3-day peak formation high. So it gives you a better scenario of the price going down more likely than the second one, like a second 2 legs M formation, because it doesn't carry a lot of volume. So so a lot of times you might expect a small push rather than a big push. Like for an example, if you're trading this, you can expect a first push would be like this. The first wave could end up like this and then consolidate. But if the price does the 3-day rise, 3-day peak formation high, you can expect the price to drop a little bit more because it carried a lot of volume. Okay, so putting all things into perspective, basically USD JPY looking like a bearish move, and currently the market maker already finished the trend, and that's a WVVM. So what we're waiting on is a MAAW, and that could push the price all the way to the low, or it could push the price to the mid-range, maybe around 61.8 range, or maybe 100. It all depends on how the pair will play out and how the volume has been collected over the few days, because each level will define your waves, because the longer the consolidation, the bigger the push. Like for an example here, how long this consolidation was and how long the impulse was. Look, it was a big amount of pips. So that's the reason, and that's why the level 2 didn't consolidate, because level 1 got enough volume, so level 2 doesn't need to consolidate anymore. Sometimes you might see level 1 being small and then level 2 being big. Because it all comes down to the part of how much volume is in the market. If there is no volume in the market maker's job is to create volume. That's why they are there. Okay, their job is to create momentum. Their job is to create volume. Okay, when the market doesn't receive any volume, the market maker's job is to put money in the market to create the momentum. That's their job. So think about it that way, okay, for a second. It's going to open a lot of minds. So I don't want to get into deep into those subjects. I'll save that for another day on another topic, okay? For now, let's focus on USD JPY, and we know what's going to happen. So let's wait it out and see how it goes, okay? And here is the support area, the neckline. So once that breaks, then we can expect a level 1 consolidation. So let's wait it out and see how it's going to play out for the next week, because right now it's Friday. Market's about to close in a few hours, about give or take about 8 hours, between 8 to 9 hours. So you might see a move or you might not see a move. It all comes down to how much volume has been trapped. So most likely it's not going to drop. What I feel like, it might go back up for the next week and then continue to drop. But we'll see how it plays out. If it continues to drop, we're going to be looking for a sell, okay? All right, guys, trade under your own discretion, and always use proper risk management. So the rule of thumb to do a proper risk management is always do 1% risk. So for an example, if you have, let's see, if you have basically $1,000 and you're doing 1% risk, okay, that's about $10. How do you define that $10 into a pip? So whenever you have a pip stop loss, always pre-calculate. For an example, if you're selling here and you put your stop here and you put your take profit here. Okay, so whatever this take profit is, forget about that. Focus on the stop loss. So the stop loss could be around 40 pips. Okay, so minus 40. So this $10 would be divided by the 40, and that's gonna give you an average 1 pip value. Okay, so let's take out our calculator and I'll show you real quick. All right, 10 divided by 40, not 40 divided by 10, 10 divided by 40, okay? Remember that. So now you got a pip value of, 0.25. So that's your pip value. So your lot size always have to be like this. Like this. So basically your lot would be 0.02. So that's going to be your lot size. So when you do that lot size and you take a 40 pip stop loss, if the price does go end up hit your stop, guess what? You only lost 1. And that was around $10. That's it. But however, if you did win, that's a lot of pips. Okay, that's around, let me average it out. Let me see how many pips that is. Give or take, that's around 300 pips. So 300 pips out of 40, 300 divided by 40, that's about 1 to 7.5% risk reward. So you're only risking 1% to make 7.5% gain on this trade, only on a single trade, 7.5. Okay, so but a lot of beginners and a lot of immature traders, they risk more than that. So this is what I'm trying to explain to you guys. It's not about how much pip you risk. It's not about how much pip you win. It's not about how accurate you are and all that. Nobody is 100% accurate. So if you are 100% accurate, then yes, go for 100% risk, right? But you're not 100% accurate, and you'll never will. So in order to stay safe, and in order to stay ahead of the market, and in order to be a profitable long term, you need to have a perfect mindset and have a risk controlled by always having a 1% standard. That's just the standard of your 1%. And once you are comfortable, once you're trading for 5 years, 10 years, and you have tracked your progress, you have seen your results over the years, and you have been seeing how well you performed over the years with a great amount of accuracy, then sure, raise this bar up to 2%, maybe 3%, but always make sure to track yourself. Always make sure to look at yourself. How great trader are you in the first? Then go and risk a lot. Most of them are just the beginners, and they're just learning. They haven't even completed any full course yet. They haven't even mastered any strategies yet. They learned 1,000 different ones, but they haven't mastered one strategy yet. So when you don't do that, what happens is you basically end up losing, and then you're gonna give up on the Forex trading. So you don't want to do that. You want to be in here for a long haul, and for basically, in order for you to risk only 1% to make 7%, that's a good trade, and that's a good risk reward also. So it's very important for you to follow all these things in order to be a consistent trader. All right, guys, I'm not going to yap about more about risk management. Maybe I can save that for next day on a different subject. But I felt like I have to tell you guys because some of you guys just don't follow risk management and just follow the biased direction. Like if I'm saying buy, you just got to buy without even thinking, without even doing your own analysis, without doing your own risk management. You're not going to be able to be successful. This is a trading, guys. It's not something that you can take lightly, something it's a hobby. It's not a hobby. It's a full-time job. And people who do that, you gotta respect these people, because they lose money to make money, and that's a difficult job for a lot of traders. And I respect all the traders who are trading full-time and trying to make their ends meet. But for a lot of beginners to basically see it as a disadvantage, and basically having a negative vibe around the community is very bad. Okay, I mean, I don't clearly like the fact how people what they call it, take trading as a lightly. Like they take it as a hobby, and when you take it as a hobby, you look at it as a gambling. And majority of the time, everybody's expecting to make like 100%, 50%, like huge ROI, like above and beyond expectations. And that's really not the case how with Forex trading. If you've been trading for 2 years and 2 years or more, you will know that Forex is not like that. Forex is more of a conservative traders. Like people who are conservative, they're the one who's going to make the most money in the long run, because it's not the sprint, it's a marathon. All right, guys. So just keep remembering all the things that I have teach you guys. And if you guys benefited from it, just leave a comment, like, and share this video. That's all I care. All right, guys. I'll see you guys next time. Until then, peace out and have a bullish weekend.